was a tough end to the week for risk assets as the major equity indexes finished lower here on Friday. Today, we're going to talk about three charts that really tell the story of the bear case for equities going forward in what seasonally is usually a pretty weak month. We'll talk about the chart of the S&P 500 on weakening momentum. We'll talk about the increase in volatility that really became prevalent here this week. And finally, we'll talk about our old friend Dow theory, or what I call the newer Dow theory, really flashing signs of weakness going into early September. What does this mean for the S&P 500 and the NASDAQ? Check out these charts here in a minute. But before we do that, one more thing I wanted to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seekingalpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seekingalpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So here's how the chart of the S&P 500 looks after this painful week for risk assets. The S&P finishing lower about 4.25%. The NASDAQ 100 almost 6% down for the week. And as I'm reflecting on what we learned through the course of the last 4 trading days in this shortened holiday week, is the fact that it more and more confirmed that peak in late August was a failed attempt to get to a new all-time high, right? Going back to Charles Dow's work from the early 1900s really laid the foundation of technical analysis as we think of it in the modern financial age. And I would say that, Charles Dow, one of his great contributions to the technical toolkit was just the concept of trend following and thinking about the peaks and valleys in prices and how that behavior of those peaks and valleys can tell you a lot about the underlying sentiment, the underlying market conditions. The fact that we've stalled out here over the last 2 weeks in August and now the first week in September rotating lower really sort of confirms that recently we have been attempting to make a new high above 5650. We have failed to do so. Now, what's interesting about the chart of the S&P 500 as we close back up below the 50-day moving average for the first time since late July is the fact that the momentum picture has looked a lot less strong through the course of the month of August. Look at where the momentum was. The RSI indicator read here in mid-July as we approached the new all-time high, just above 5650. The RSI was over 80 actually the second week in July. We retest that level again here in late August, and the RSI stalls out around 60. That creates what you probably consider as a bearish momentum divergence. Now, for a classic divergence, you would need the chart to make a new price high on weaker momentum. But the fact that we're retesting those levels and the momentum is clearly trending lower certainly implies that the momentum is certainly not supporting a move to new highs. What you want in a healthy bull market phase is for the market to move higher on stronger momentum. And all those new highs ideally are overbought because more and more upside momentum is pushing the price to the upside. We didn't get that here in late August, now into early September, as the most recent attempt to make a new high in late August was met by much weaker momentum. So we do have, I would argue, a bearish divergence with weaker momentum. Tells you that conditions are not as strong as the price might imply. Another data point that we talked about certainly in the month of August, particularly in that initial sell-off in late July into early August, was the VIX. The VIX on a closing basis finished just above 38. On an intraday basis, this was actually above 65, one of the highest readings in the history of the VIX going back decades. So it's very rare that the VIX ever gets up to that level. For me, a VIX below 20 is sort of a low volatility, maybe a brief pullback at worst, but conditions are still pretty constructive. A VIX above 20 really speaks to elevated uncertainty, elevated volatility, elevated fear, and most likely that coincides with equity prices getting dropped, right, with further drawdown. So to be honest with you, I'm surprised at how low the VIX got after that initial spike up into the 60s. Again, an incredibly rare high reading, because very soon after, about a week later, the VIX is all of a sudden down in the mid-teens again. It was not sitting right with me. So as the S&P was making or attempting to make a new high above 5650, and the VIX had come back down, in the back of my head, I'm thinking, I'd be amazed if the VIX spiked all the way up that high and then it was just over as quickly as it had started. Sure enough, this week, the VIX pushing back above 20, and as the way I would think of it here in September, every day that the VIX remains above that 20 handle, that tells you more and more likelihood of further deterioration in risk assets. That gets us to our last chart, looking at what we call New Dow Theory. New Dow Theory is really based on the original work of Charles Dow, and again, laid the foundation for most of what we think of as the modern technical analysis toolkit. But Charles Dow also had the idea of indexing and really popularized the idea of tracking market indexes. And what we now call Dow Theory looks at different indexes like the Dow Industrials and the Dow Railroads, which are what he originally designed. Are they both going up? Are they both breaking out? That's bullish. Are they both breaking down? That's bearish. Are they in disagreement? That tells you we're probably at a market inflection point. Now, if you look at the Dow Industrials and the Dow Transports, there actually is a bearish non-confirmation or a divergence between those two indexes. I don't like to use those indexes because I don't think the Dow Industrials and the Dow Transports really speak to what Charles Dow originally intended when he created that theory. I think a more modern and more relevant version of Dow's original work is what I call Newer Dow Theory, looking at an equal-weighted S&P 500, which did make a new all-time high in late August, and an equal-weighted NASDAQ 100, which did not make a new all-time high. So this pattern where one of the indexes breaks out and the other one fails to confirm that breakout, that's called a bearish non-confirmation, meaning instead of confirming one another, one of them is not doing so. This happens very often at major market tops because one side, think of the old school versus the new school, or the old economy versus new economy names. Part of those stocks, particularly the old economy names, are still doing okay, right? And you're seeing a lot of breakouts in industrials, financials, healthcare, a lot of materials, for example, making new highs. Whereas in the growthy stuff and technology, communication services, some consumer discretionary, charts are not looking nearly as strong, and you're having less of those break out. That's why the equal-weighted S&P has made a new high, while the equal-weighted NASDAQ 100 has not. Now, what does this mean? I will tell you, quick plug, my Market Misbehavior Premium members get to follow along with me as we track these signals and navigate the very uncertain and seasonally weak part of the year, September. September is often a painful month. October into November often creates some really interesting opportunities. I look forward to tracking those moves using these charts and others. If you're one of my premium members, go to marketmisbehavior.com/premium. Use the code YouTube for 20% off your first 12 months on any plan. Check it out. And if you want to upgrade your understanding of these markets, have someone to follow along with you and help keep you accountable and help you make sense of things. Check out our premium memberships. Now let's get to the bonus chart, the Hindenburg Ohm, and I'll put a link in the description for previous videos I've done on this fantastic market top indicator. It's a very interesting indicator, really combines trend and breadth analysis to identify conditions that are very common at major market tops. Jim Aka, who created this indicator, looks for three things. Number one, the market's in an uptrend. Number two, new highs and new lows expanding. Number three, breadth turns negative. We'll go through each of those one by one. Number one, the trend in the market needs to be positive. This indicator only works if the market trend is positive. So we look at the New York Stock Exchange Composite Index. Is it higher than it was 50 days ago? Then that's a thumbs up, which it currently still is. Number 2, you need an expansion in breadth on both sides, meaning there are stocks making new highs, which is common in a bull market, right? And you can see the green bars show you how often in 2024 we've seen stocks making new 52-week highs. That makes sense when the S&P itself is making new highs. But you also need stocks making new lows, because one of the things that the creator of this indicator found is that at major tops, you often have indecision and some stocks going up, but a lot of stocks actually going down at the same time. And that's a surprisingly common feature at major market tops. We actually got that Thursday into Friday's session, as over 2.5% of the New York Stock Exchange listings made a new 52-week high and a new 52-week low on the same day. Finally, we need breadth to be positive and turn negative, and we do that by measuring if the McClellan oscillator goes below 0. For most of August, it was above that 0 line and actually just dipped back below this week. So the composite indicator is showing a positive 3. Now, it's worth noting, for this indicator to be confirmed and completed and fully valid, you need 2 sets of signals or multiple signals within 1 month, within 20 trading days. We have had a number of initial signals in February of this year, in late May and early June, but they weren't within 1 month of each other, so it was not a confirmed and valid signal yet. That's what I'd be looking for on the chart of the Hindenburg Omen. Again, check out our premium memberships if you want some help tracking these macro indicators and hopefully upgrading your market awareness. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.